Hi, and welcome to this week's Symax Fintech Market Insights. As usual, we've split this into 4 parts, and this is just really to help you guys prepare for next week. So I hope it helps. As usual, we start with our disclaimer. So trading involves the potential risk of loss of capital. It's not suitable for everyone, although hopefully it is for you. When it comes to leverage, just be careful because you can lose substantially more than that initial investment. Everything we include in here is just purely for educational purposes. We're not trying to provide you with advice, we're just trying to help you prepare, understand the markets better, to help you make better decisions. But of course, if you are looking to invest or trade, that has to be your decision. And before you make that, you should consider your financial situation, your level of experience, and your risk appetite. And of course, on your risk capital, you're prepared, but more importantly, can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before risking your capital. Okay, if we look back at last week, central banks flooded us with rate decisions. Not too many surprises, just couple there. So the Fed held rates unchanged. It was a 7-12 vote though, so it wasn't too far away from another hike. And that dot plot, which is so important, they only release this every other meeting, and this was one of the times when they did release it, and it's still priced in the chance of one more hike. Obviously that's going to depend on inflation, if it rises or fails to continue to fall, really. The dollar held up to its recent gains. Dixie sort of 105, it did sort of move higher than that, especially there's a bit of weakness in the pound and the euro at the moment, I would say, which again is helping. Now stocks had a bad week, a terrible week really, and although they finished off from their lows, for me that was probably just a little bit of profit taking. And Powell's comments are pushing treasury yields higher. They actually hit a 16-year high. So if we move on and just sort of look at the data from last week, there wasn't too much in the US. So the housing index were lower than expected, as were housing starts, but permits were actually higher. Permits are when they're preparing to, bought land perhaps, and they're getting ready to build, so they need permission first. Fed funds remain 5.25, 5.5. I'm going to cover that a bit more in the part 3, which is the macro outlook. Surprisingly, initial jobless claims was still down, lower than expected at 201,000. Philly Fed came in lower than expected, negative 13.5. The PMIs, so the composite was 50.1, so above 50 is growth. Manufacturing 48.9, but that was better than expected. And services came in at 50.2. So as I mentioned a few weeks ago, I expected sort of the manufacturing was bottoming out, and services were probably getting a little bit overdone, and we're seeing those corrections coming through now in the data. But they're all not that far away from 50, which is, well, for me is where they need to be. Okay, so moving on to the EU. So CPI was pretty much in line. Core came in at 0.3% month on month, 5.3% year on year though. So still way too high. Consumer confidence was negative 17.8, and that was lower than expected. Then the PMI composite came in at 47.1, which was higher than expected, but again, it's still well below 50. Manufacturing was lower than expected though in the EU, that was 43.4. And services were 48.4, which were better than expected. So overall not terrible, but again all below 50. That manufacturing still remains a concern when it's down in the 40s. Okay, so moving on to Germany, again PMI, so the composite was 46.2, which was higher than expected. Well, in fact, it was all higher than expected. Manufacturing came in at 39.8 and services came in at 49.8. So, you know, they're on their way up, but, you know, Germany's supposed to be the powerhouse of Europe. It's certainly not there at the moment. Okay, so let's move on to the UK, where I'm based. So the Bank of England narrowly voted to keep rates unchanged. I mean, it was a 5-4 split decision there. So rates remain at 5.25. Now, if we look at CPI, so the headlines came in at 0.3%, which was lower than expected, and 6.7% year on year, with the core being 6.2% year on year. So, you know, obviously that is still too high. You know, how long it's going to take for that to come down, you know, we're talking 2024, 2025 before we see these target 2% rates potentially. And then PPI, so PPI was negative 0.1%, the core month on month, which gave us a 1.6% year on year. So again, you know, you're seeing that difference with costs versus what we are being charged. Those inflation rates are still high, just for me because of corporate greed. The retail price index came in lower than expected though, at 0.6% month on month, but that still gave us 9.1% year on year. Consumer confidence was better than expected. That came in at a negative number. RS, so retail sales, was 0.4% month on month, which is a negative 1.4% year on year. And then PMIs, so the composite was lower than expected at 46.8. Manufacturing 44.2, services are lower than expected at 47.2, quite a bit lower actually. So again, you know, it's the UK could be heading for a recession. You know, some of this data is sort of starting to head that way. Okay, moving on to Swiss National Bank. So Switzerland, their rate decision, it was a little bit of a surprise for most. They came in at unchanged, so they left rates at 1 3/4. And for China, similarly, they left their rate unchanged at 3.45%. Moving on to Japan, they left, surprisingly, rates unchanged, still negative 0.1%. You know, UAIDA sort of gave that earlier sort of indication that they might be prepared to move on rates soon, but then other ministers came out and said no, that's not what he meant. So again, that sort of left a little bit of uncertainty there, which pressured the yen. When we look at the PMIs, so manufacturing was lower than expected at 48.6, but services 53.3, so quite strong there. Also, while we're there on Japan, the CPI, so 3.2% year on year, the core 4.3% year on year. If you take the food out, then it's 3.1%. But again, you know, above that target 2% inflation that most central banks seem to be targeting and hoping for. You know, before they hoped that, go back years ago before COVID and all that, everyone hoped that they could get to 2% on the upside. Now everyone's hoping they can get to 2% on the downside. Okay, so if we move on to Canada, CPI, so the core was 0.1% month on month, 3.3% year on year, with the headline at 4%. So still too high, but you know, inflation is starting to move in the right direction, and the closer it gets to that 2%, the more difficult it's going to be to achieve. Housing data wise, that all came out in line. Retail sales was 0.3%. Again, you know, it's not too bad. Ex autos, it was 1% though. Then moving on to Australia, so another meeting there. So this is the minutes from it though, just sort of outlining their reasons for leaving rates unchanged. And then we look at the PMI, so the composite 50.2, the manufacturing 48.2, and services 50.5. So for most countries, you know, the PMI is not too bad, not great, but you know, everyone wants to see it over 50 because that's expansion. And of course, if it starts to drop and drop steadily, then that's a concern because then we're going into contraction. Okay, so finally New Zealand, their GDP came in at 0.9% quarter on quarter, which was 1.8% year on year. They did daylight saving time, so their clocks changed the weekend, so just be aware of that if you're following or trading Kiwi or anything like that. So just moving on to highlight what we do as a company. Obviously, the majority of you are probably familiar with that, but there's always some new people viewing these. So it's just to give you a little bit of an insight into Symax Fintech as a company. So apart from the YouTube, we provide daily newsletters, which include sort of global headlines, global news, and then as an option, there's fresh chart levels and pivot points each day. Then when it comes to sort of workshops, you know, if people are looking to get into trading, then our sort of introduction to trading is a great one, trading for beginners. And then for others that are already trading but have got gaps in their knowledge or their trading skills, then we can help you with those as well. We do offer 1-week courses. They can make you feel competent and confident in just 1 week. Does it make you a trader? No, but does it give you the foundations on which to build your trading career? For sure. And you know, if you've got that inner trader, I will find it. And of course, now you have the option of going for one of our new course, which actually includes a free trading challenge attempt as well. And then if you're really serious about making trading your career, then our comprehensive accredited masterclass is the one for you. It's designed to provide you with all the knowledge and trading tools required to navigate any market conditions, and also any asset class. And the next one of those starts on the 19th of June. So you've got a week to register if you're interested. Then trader mentoring, you know, some people don't want to go through courses, but they do need help still, and I can certainly do that. Consulting, we consult to companies around hedging, FX and commodity exposure. And then of course we provide you know, a mass of educational content that can be to individuals, exchanges, to brokers. And as I just mentioned, if you're looking for that funded account, you know, maybe you're a bit sort of undercapitalized, or possibly you just don't want to use your capital, then there's the opportunity to go through the challenge and hopefully qualify for a funded account through one of our partners, Nordic Funder. If you'd like to contact us, it's info@symaxfintech.com. Any questions you'd like to aim directly at me, it's chris.tubby at Symax Fintech. Sorry, go back to that one, christubby at symax-int.com. Just get so used to the fintech part. And of course, look forward to seeing you in the second part.